appreciate you taking the time to join me here today. I have a lot that I want to cover. First, I want to go over some events that are coming up that I think a lot of you will gain immense value in attending. So I want to hit on some of those things. There's some new headlines this week. We're never at a lack of headlines when it comes to tax, accounting, and regulatory news lately. So we're going to go over some of those topics as well. And then there's a few tax questions that I'm seeing that I want to hit on and sort of give my input on, as well as some things that I've been seeing in my practice that I think will be interesting for you to hear and can help give you some insights, whether you're a Web3 business owner, digital asset investor, or a CFO or tax professional in this space. So let's get right into it here. I'm going to start by sharing my screen. We'll get into some of these topics here. So let me just make sure my screen is sharing correctly. I think we are. So we look good here. All right, awesome. So the first thing I want to go over, as you can see here, I partnered with the Crypto CFOs, which is a great group. I've been part of this group now for quite some time, probably about a year or so. It's a private networking group. They have their own private app, desktop and mobile, with a ton of information in it related to digital asset accounting and taxes. So we partnered together on this specific topic, demystifying NFT sales taxes, essential insights for tax and accounting professionals. So I'm going to be teaching this. It's a CPE event. So if you attend this, you'll get 1 CPE credit. And we're really going to be going over a big knowledge dump of where are we currently at with NFT sales tax regulations. This is a new element of taxes related to digital assets that currently is going overlooked to a fairly large degree. It's something that I've been deeply focused on. I've been putting out a lot of content on it, advising a lot of clients on it, working with them directly on it, and also building an automated solution to address some of the compliance needs related to this. So in this event, we're going to be going over all of that. As you can see right now, we have 262 people registered on LinkedIn as attendees. Now, when you go over here to register, if you do go on LinkedIn, you're going to have to click this link and it'll bring you to Crypto CFO's website, particularly a landing page related to this event. So, you can sign up here and register for this event here. So we have about 260 or so people signed up here, 262. There's more people signed up privately. That isn't posted on that LinkedIn page, and they're just signed up via the Crypto CFO's platform. So we're going to be going over state-by-state NFT taxation, risks associated with non-compliance, best practices to get into compliance, and some other very important related topics. So like I said, I've been out in front sort of pioneering this NFT sales taxes, and we're going to get into all the details here. So I encourage you to sign up for this. This is an opportunity for you to learn about an area that, again, is currently going overlooked. Us as crypto CFOs, crypto CPAs, we need to be proactive investors to our clients. So learning this now and making your clients aware of this positions you in that role as a proactive advisor. And I believe if you own a CPA firm, CFO firm, that's really the role that you want to play. So that's that. Sorry, I got distracted there for a second. So the next article I want to get into sort of relates right into this. So this is from Accounting Today, by Chris Gaetano, and this is actually on NFT sales taxes. So regulating crypto NFT sales taxes looming. So this article, actually I was interviewed on this article. So I'm sort of delivering some of the information in here in an interview that I did with Chris. But basically, we're talking about a high level overview on where NFT sales taxes stand right now, and a lot of the future risks associated with it. As you can see here, I've characterized this as a Wayfair 2.0. in terms of the potential impact that sales taxes can have on our industry. This almost in a way feels like crypto taxes back in the 2016, 2017 era, where it's something that people are largely unaware of. Definitely the people, Web3 CEOs are unaware of it, but even tax professionals in the space are also unaware of it. So it's going largely overlooked. And as you can see here, in terms of the Wayfair 2.0 reference, that happened in 2018 as a result of this proliferation of interstate sales through all these online marketplaces and online sales becoming popular, like Shopify and these others. And then we had the 2018 Supreme Court case that basically changed sales taxes here in the States and stated that when you're selling from one state to another, you basically still have to collect sales taxes. That's the long and short of that. I don't want to go into too much details on that and get too much in the weeds here, but basically the reason why I think NFT sales taxes is Wayfair 2.0, because just like we have this proliferation of a new almost form of commerce with e-commerce, now we're sort of having the next generation of that with NFTs. Creates entirely new business models, and with that comes entirely new tax issues, and sales taxes is going to be one of those issues. So this is a really great article, and Chris was able to cover a lot of details in it, so I encourage you to read this article. In addition to sales taxes, this article also will mention VAT taxes as well, because this is not something that's just going to be a issue here in the US with sales taxes. We're seeing countries positioned to apply the VAT taxes to NFT sales as well. As you can see here, we have Working Paper 1060 of the European Union's Value-Added Tax Committee, which was released in March. This confirmed that NFTs are subject to VAT taxes, but this is still a working paper. I expect more guidance to come out of the European Union. So we've seen a few countries already say that NFTs are taxable for sales tax purposes, and we've seen several states list this as well here. Washington State's listed in this article. Washington State, from my perspective, at least right now with their interim guidance, they were the first state to put interim guidance out when I first started really focusing and covering on this issue back in last July. There have been other states as well that have given guidance. Wisconsin, Minnesota, Washington, among a few other states. And as this article states here, there's already over 31 states that apply sales and use taxes to digital goods. Washington's already shown that states like Washington that apply taxes to digital goods are likely going to tax NFTs, and this is going to be done retroactively due to the tax regulations that are already on the books related to taxing digital goods. So there's a huge tax issue looming with this, and I believe that's why we've seen Accounting Today, feature this article related to this. And one of the biggest is right now there's not many automated solutions that are available. There's not really any automated solutions that are going to be able to enable a company to properly collect, remit, and report sales taxes. And that's what me and my team have solved. So if you are just becoming aware of this and your company needs to get into sales tax compliance, or you have clients that need to get into sales tax compliance, contact me today, and we can start looking at how we can assist with that. So again, I expect there to be many more headlines related to this, and this to become a huge tax issue in the future. Exactly when, of course, I can't say, but I don't view this as a tax issue that's going to go away, particularly when we consider, what the future is related to NFTs. Basically, they're going to be used in a lot of different forms and in a lot of different business models outside of just artwork. So expect this to be a huge issue going forward. So the next article I want to cover is Judge Suggests IRS issued 4K refund over lawsuit based on quality of lawyers. So I thought this was interesting. This is out of Cointelegraph. So if you remember, there's basically this court case over the Tezos staking tokens and the timing of the taxability related to this. There's been this court case that basically was trying to make arguments that the staking should not be taxable when you receive the tokens. They should only be taxed when you sell the tokens in the future, similar to baking a loaf of bread is one of the examples that they gave. So oral arguments for this began on July 26th in an appeals case. And this is happening in Tennessee. So basically, the IRS, instead of issuing a judgment on their court case, basically just issue them a refund in order to stop the process and not have to go through actually giving them a ruling. So they refused to accept the check, which is now expired, and they've been filing appeals. So now they had a judge look at this on just yesterday, basically July 26th. Chief Judge Jeffrey Sutton of the U.S. Court of Appeals suggested the IRS may have issued the refund as a way of picking off taxpayers with very good lawyers without ruling in their favor for the initial complaint. So that judge seems to be to think like that they have a good argument and that the IRS is trying to avoid actually taking that argument to court and arguing it based off of its merits. I thought that the Jarrett's argument was not that likely to hold up, but apparently this judge thought that their position was strong. So the Jarretts have been at this case for a while. They're not letting it go, and this is still a developing area that we're watching closely. I know when this court case first came out, I was starting to get a ton of questions about the timing and the nature of when you should be claiming income for staking rewards. Unless we do get a court case or some type of guidance that says otherwise, the conservative position and the position that I would expect someone to take on return would be to have the staking rewards taxable upon receipt based off of the fair market value on that date. That'll also set your cost basis in that asset. So if you do sell it in the future, it won't be taxed. So let's watch this closely here, and we'll see if anything changes here in terms of future court rulings, because oral arguments for this just began yesterday, as of the time that I'm shooting this. So that's something that we'll continue to watch closely here. So here's another article out of Accounting Today called "Regulating Crypto." I thought this was another interesting piece. The focus on this piece is basically looking at people that are coming into the industry that are investors or businesses, or people that are also coming in as tax professionals or as CFOs, and what are some of the bigger things that they need to be aware of and that they need to watch out for when they're assisting their clients or when they're getting their accounting or their taxes completed. So there's a lot of good information in here. We're not going to be able to hit it all. I encourage you to go check this article out. This article was also posted by Chris. So some of the things that they hit on here, I think, are worth touching on. So the first thing is, something I've been dealing with for years. Some clients still don't think they have to report their transactions, or they think they can do tax fraud on a public immutable ledger. But of course, that's not the case. You probably heard me harp on that already. Here's some input that I gave. Even clients know what needs to be accounted for, they can struggle to track cost basis properly. This is probably something you've heard me speak of before. Tracking your cost basis is a cumulative process. So I see tons of people that are either, starting to do their calculations themselves, or they go and they work with a firm that unfortunately, can't deliver on the engagement, and they're left with inaccurate accounting, particularly inaccurate cost basis information. And this leaves them in a scenario where you're going to have to redo that work to get it accurate, or you're going to have this issue that as you start going into your future years, you're going to have inaccuracies that carry over from that ending cost basis into subsequent years when you sell those assets. So tracking your cost basis is a cumulative process over multiple years, and inaccuracies in any one given year can start to carry over into multiple years. So as you say, this is something I frequently harp on with clients. It sure is. And then we get into applying consistent pricing methodologies on your assets and really scrutinizing that. So I was really getting into this cost basis information. I think that's one of the biggest problems that I'm seeing right now. And then we're also here. I didn't mention this part. This was mentioned by someone else, but looking at the proposed cryptocurrency guidance from the Financial Accounting Standards Board, that may be something that I cover in more detail on a future video. It's something that I've been watching closely, but after reading this, I don't think I've maybe posted as many videos on that. So maybe that's something we can touch on more in the future here. And then they get into tax consequences. So this article, again, it's a lengthy article because it includes a lot of great information. If you're looking at CPA firms, or if you're a newer tax professional, CFO in this space, I think this is a great article to check out. Just a lot of good information in here. Just seeing if there's any other big that I want to hit on in here, and then we're talking about the new NFT taxes. We've covered that in prior videos. So a lot of information in here. I started touching on, the NFT classification on the tax side, as well as the sales tax side here as well. So this article is packed with information, and taking a look at, there's tons of tax issues right now, as you can see. So you need to be proactive when you're advising clients, if you're a financial professional, and get them this information before it starts to be some issue that sort of blows up on their lap. That's what I try to do when I'm working with my clients, is be proactive, get these issues in front of them. Sales taxes are a great example of that. But all these issues, there's many issues just listed in this one article. So I think there's a lot to go through there. So then we come to this tax question that I recently saw on Reddit. So it says, gentlemen, will using our crypto cards to pay for household bills, etc., draw any attention from the IRS? So I thought that this was an interesting question for a couple reasons. Firstly, for US tax purposes, the way that crypto is classified right now, the fact that it's taxed as property makes it very prohibitive from a tax perspective to use it transactionally. The reason being is because every transaction that you make is going to be a taxable event that needs to be accounted for appropriately and needs to be claimed on your taxes. So, if you start using crypto assets for smaller purchases like this, you're going to be increasing the administrative burden and tax risk associated with your portfolio just from that perspective. I personally would like to see some de minimis threshold, which we've seen proposed in the past, but we haven't seen get pushed through, to have some de minimis threshold related to spending crypto. So, crypto, it can still be taxed as property, but if you spend under a certain threshold, under $50, you don't have to track that and claim it for taxes. This way we can facilitate payments via crypto but still keep the integrity of the tax system. That's something I would like to see. Right now, that's not the case. So if you're going to pay household bills or purchase groceries in crypto, every single one of those things is going to be a taxable event. So picture if you're paying your electric bill in crypto every month and it's a taxable event that we have to account for you. It's probably not something I'm going to be inclined to do unless there's a direct benefit to doing so that outweighs that. So that's the first thing. It's just that our current taxation structure is prohibitive to crypto really being used as a payment method on a large scale, especially for smaller transactions. Now, if you get into larger transactions, it's not as much of an issue. But I think for these smaller transactions, it is an issue. Additionally, saying will this draw any attention from the IRS? So let's think that one through for a second. So basically, it seems like that they want to basically take their crypto and use it to pay bills, and that possibly they're not compliant with the IRS. That's probably why they're worried about drawing attention from them. I mean, if you pay taxes on all of your crypto transactions and then you want to go and you want to use that crypto to purchase basically anything, I don't think that's necessarily going to cause issues for you. If you're not claiming all of your transactions, if you're not reporting at all, if you're under reporting, I think you can have some problems then, especially if there's some tax reporting that's done from whoever the company is that's providing the card and the payment service. They may 1099 you or may send some information to the IRS. So ultimately, I think this person is starting to realize an issue that if you're going to be non-compliant and you're going to underreport your taxes, eventually you're going to want to spend these assets, either in the form of making small purchases, in the form of maybe making big purchases like a home, or if you don't spend it, you're at least going to want to pass it down to the next generation or donate it. So eventually you're going to have to do something with these assets. And if you haven't been compliant, it's all going to come out eventually at a certain point when you go and you try to transact with a third party and you go and you try to spend it. These are all going to be risks for someone that's not compliant. So definitely, if you're not paying your taxes, I probably wouldn't want anyone to know I have crypto. I surely wouldn't be signing up for crypto credit cards and then not claiming any crypto taxes, because that just doesn't make any sense. So I think this highlights two important things. Number one is that if you're not compliant, you're going to have a very hard time in the future as these crypto markets mature and you maybe want to take some profits, or you want to reallocate your portfolio to different assets outside of crypto. You're going to have issues there. And also, this highlights the fact that our current taxation structure is prohibitive in terms of allowing people to spend crypto without a huge administrative burden. So, these were some of the tax topics that I wanted to hit on today. Now, every week on Tuesdays, I post a digital asset digest, which is a newsletter that delivers a lot of interesting information, similar to what I cover here, but in more detail. And I'll also cover topics that I'm not able to necessarily hit on these lives, because I do try to keep these to 20-30 minutes and keep them short and concise for you guys. So if you go to my website, you go under resources to this digital asset tax and accounting newsletter, you could sign up for the digital asset digest here, and we'll deliver relevant, proactive, timely information on tax, accounting, and regulatory changes related to Web3, related to digital assets, straight to your inbox every Thursday. So be sure to sign up for that. Be sure to also go over to the Crypto CFOs and sign up for the CPE event that we're doing on NFT sales taxes. I will demystify that for you. I will give you a complete knowledge dump, everything that you need to know. I'm on the cutting edge of research related to this. I've been researching this topic for the past year. We're going to deliver a value-packed CPE course. It'll be the best one CPE credit you've probably gotten all year. So be sure to sign up for those items. And overall, I appreciate you taking the time to watch me. I know your time is valuable, and I hope that you gained some valuable insights from this. Until next time, I'm Patrick Camuso, signing off.